Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. European futures slump following a surprise hawkish turn by the Fed. Officials rein in their forecasts for next year's rate reductions. Bank of Japan Governor Kazuo Ueda expects gradual price rises, but warns he needs more data on wages to make a rate move, putting pressure on the yen. Next up, the Bank of England, the MPC, is expected to hold rates later today amid stagflation fears.
In the meantime, a quick check on these markets. Red on the screen when you look at the futures picture, an overhang from the Federal Reserve and the move you saw in the stock market yesterday. Eurostoxx 50 futures down about 1.6%. The FTSE 100 right on its heels, 1.1%. A 10-year above 4.5%. And as Anna mentioned, the yen is weakening off the BOJ decision, 156 on dollar yen. But it's the currency move in the dollar that I think is so important. Just in the last 2 days, I was here 24 hours ago talking about a 104 handle on euro dollar. We are now at a 103 handle. The countdown to the opening trade starts right now.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher.
Is the Fed one and done? And when I say one, I mean 1%. We've lowered by 100 basis points. Is that it? Once you stop the car, how easy is it to get the car moving again? Looks like we're going to get a pause in January. The market's certainly pricing out significant rate cuts for next year. If that is the case, and the Fed is one and done, how big a problem is that going to be for the rest of the world? We've got to think about the BOJ. We've got the Bank of England also on deck today. We've got the Riksbank to worry about. Global central banks are reeling right now from the fact that the Fed might be done, might not be done, but we're getting close.
Yeah, I mean, it's certainly livening up the conversation, isn't it? I remember pre-Christmas periods, pre-holiday periods...
Big dull.
Where they were dull, or where Powell brought the festive spirit and festive cheer. Well, this time it was much more like the Grinch, wasn't it? This hawkish cut for the Federal Reserve. So the cut came as expected. We also got hawkishness as expected. Anyone who was watching this show yesterday would know that we were bracing ourselves for that kind of hawkishness. But the market still caught off guard. We saw the S&P... down by more than 3% by the close. Big move in the 5-year yield, of course, as well. So then we look at 2020-25 pricing, and the Fed said in their median estimates we'll get 2 cuts. The market read that as, OK, no, we're only going to get 1, to your point, another one and done perhaps next year. And then we get onto the questions of Trump and his policies and what they have and haven't factored in. A fascinating conversation there.
Yeah, this press conference has kind of cemented the fact that the labor market is no longer the deciding factor, right? That it is ultimately inflation expectations. To me, I think the line from the transcript that stood out to me is that it's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down. And that's exactly what he's talking about. I mean, it makes a lot of sense.
Example.
Exactly.
Or do you just stop?
He might.
And that's the other thing.
And wait.
In that kind of environment, you just stand still and wait and see what you do and do not know. Hopefully you don't get hit by something, not a piece of furniture.
Wait for the lights to turn on.
Or policy change elsewhere.
But the fact that he's talking, and then he also mentioned on the job creation front, and I thought this was interesting because we keep going back and comparing it to 2019 levels because we are now at a strong labor market, strong financial conditions that we saw in 2019 when we did have that insurance cut from Jay Powell. And he said that job creation is now way below the level that would hold unemployment constant, way below the strength that we saw in 2019. And you're not seeing it in the headline number. He's pointing to things like surveys of workers, business quits, really nuanced labor data that's suggesting maybe not all is well in the labor market.
We've been having that conversation for ages, though. And that's the issue. The other thing I'd just like to raise, and you raised this in your board, Kriti, is the dollar is super strong. How big a problem is that going to be for the Trump administration? Is this going to make tariff policy more aggressive from the Trump administration? Presumably, you want to kind of lower the dollar as part and parcel of a package that would improve American competitiveness in so many ways. And this is working against the administration. So I wonder whether or not this just amps up the idea that the tariff policy could be even more aggressive coming out of the White House.
I'm thinking about tariff policy. I love the fact that Jerome Powell says we don't guess, we don't speculate, we don't assume, and then went on to admit that there were some people on the committee who had factored in policies
That very
around
thing.
tariffs, so they must be making some assumptions.
And they're not alone. You're seeing that in the BOJ this morning. Dollar yen going through 1.256 here on the headline, by the way, on the comment that the full picture on wages and Trump policies will take time. Again, a reaction, international reaction to that Trump story. I think this is fascinating because on the one hand, he's paying attention, of course, to the labor market and what that means, to the tariff conversation and what that means for Japan. The other picture is wages. And we just talked about in the last 24 hours, this conversation of Honda and Nissan and this consolidation. There are going to be wage negotiations that are likely going to be a part of that. That might show up in the BOJ's thinking.
Yeah, and I think they need to explore this more in the press conference because, and I'll be watching as these headlines come through, because some of the commentary seems to be suggesting he's saying he's going to be watching the spring round, which suggests waiting a long time. That's beyond January. But I didn't see that flash by our team out of the press conference specifically, so we'll see how much spring is really in the mix or whether it's just, I need more information on wages.
Big picture on wage trend to be clear in March or April. As you say, that's a long time to wait. What is interesting is, and this is a comment that is made on the top live that is currently running around the press conference that you're looking at live pictures coming from right now, Ueda is speaking, is that the more the yen weakens, the more the pressure is going to be to hike to support what is happening in Japan. This weak Japanese yen is very unpopular domestically, and there will be growing pressure politically and from a monetary point of view to do something to support it. So the problem is that the more dovish he is, the weaker the yen gets, particularly with the Fed in the background, the more pressure there will be to do something sooner rather than later. So he's really boxing himself in so many ways with the policy that is being delivered.
I almost wonder, and this is a very contrarian thought, but I almost wonder if, given its kind of risk haven aspect that comes up, when we do see the uncertainty show up in 2025, these tariff comments, naturally the bid will go to the dollar. It might also go to the Japanese yen. I almost wonder if that's a blessing in disguise for people who are worried about that currency intervention.
Maybe. It's going to be really hard to judge. The yen has not played that safe haven role in the way that it traditionally has over the last few years. It's been the Swiss franc. To your point, it's been maybe the dollar as well. Let's talk about the pound as well. What are we going to see later on for the Bank of England? Remember, we don't get much detail today coming through from the Bank of England. The expectation is that it's going to leave rates on hold, that we're going to hear a lot about gradual. That conversation is going to continue. That narrative is going to continue. Swati Dhingra is probably likely to vote for a 25 basis point cut, so we get an 8-1 split. That is the expectation. The only question I would look for an answer on is whether or not the bank pushes back against this idea that we've seen this repricing. So there has been a more hawkish repricing around the bank, concerns around stagflation, concern around the inflationary data that we're getting. Does the bank push back against that? I think is the only thing that could maybe surprise the market today.
Yeah, and I'm not sure without a press conference where would they be able to do that. But we've got this week, to your point, Guy, a lot of repricing of expectations. We started out the week pricing in more. We're no longer pricing in 2 whole cuts for the Bank of England in 2025. So again, one at the Fed, maybe one at the Bank of England. We're going into 2025 with a very different narrative globally. Yes, we've seen quite a lot of rate cuts, but we're not really sure how many we're going to get.
Just think about where we were this time last year.
Yeah,
we were
7,
going.
6,
We were off to the races. Powell had just sparked a massive rally in risk assets because of the fact that he believed that he would be able to cut aggressively in this year. He's just flipped that on its head going into next year. So we're almost kind of back to we're not back to where we started because asset prices have inflated significantly since then. But are we about to see the mirror image of what we saw this year, next year?
And that's going to be reflected naturally in the pound. We saw these massive moves in the gilts and off the stronger than expected wage data as well. Again, wages coming up as part of the central bank conversation. We also mentioned the Ofwat headlines here. Redhead crossing the Bloomberg terminal. It looks like Ofwat is setting their allowed rate of return for water firms at 4.03%.
And issuing some fines as well. Fining Thames Water £18.2 million for breaking dividend payment rules. A sector under continual pressure, it seems.
The whole utility story is fascinating. If you look at what's happening with gas prices as well, this is just, again, an inflationary input into the UK economy that the Bank of England could live without right now. We've got lots to discuss throughout the programme. Yari Sain's going to be joining us. He's Goldman Sachs' chief European economist. Plenty of questions for him. Joy Yang, Point 72, head of Asian Economic Strategy and Research. We're going to talk the yen. John Bilton, JP Morgan Asset Management, head of Global Multi-Asset Strategy. What does 2025 look like with the Fed doing what it's doing? And the Achilles heel, it seems, certainly of the German economy, the auto sector right now. Patrick Hummel joining us, UBS's head of European Automotive Research. Are we close to a deal at VW? Not his bailiwick, but we should probably get a read across from what's happening in Japan, potentially with the impact that it will have here in Europe, Nissan into Renault, etc., etc.
A lot to watch. Central Bank Palooza continues. 12 p.m. UK time, BOE rate decision. Of course, we're going to cover the Riksbank later in this program as well. 1:30 p.m. UK time, U.S. jobless claims. And then the focus shifts a little bit to the earnings story as well. Nike earnings and FedEx earnings, two major, I would argue, global bellwethers, both likely to talk about that China exposure as well. But before we look forward, I think we need to take a moment and look backward at the Micron earnings that we got in the last 24 hours. Dropped by a massive amount, a $1 billion miss on that revenue forecast. The stock plummeting after hours. PC and phone demand just not where expected to be.
Yeah, the stock down 18% at one point. I was listening to some analysis given to our US colleagues after these numbers dropped. Really interesting as to, this is the traditional market. This is PCs and phones. That's what's weighing on Micron. It is not the AI, high bandwidth memory chips stuff, data centers. It is the traditional stuff. And how much inventory correction can we still see there? We've seen a lot post the pandemic, where we saw a boom, of course, in demand for these things. And now we seem to be entering into another period of negativity. There'd been this talk that maybe AI was going to boost a refresh cycle for phones and PCs, and that just hasn't happened. But some analysts saying, look, we can't go much lower on this story because there just isn't the inventory. It hadn't been rebuilt.
So the low, just to kind of put today's move, though, in context, the stock did get a big bid when we saw Broadcom rise.
Yeah.
So we've unwound some of that. We are definitely going to go significantly lower today. But even back on the kind of the 15th, the end of that week, we were trading at 95. So the stock has risen quite sharply since then. We got up to a high of 114. So there's been a decent rally. Some of that's, in fact, all of that's being unwound. We're going to go lower than that. But nevertheless, I think we're sort of backing out some of the recent rally we've seen in some of these chip stocks, where we've seen a really big concentrated move. As everybody's piled into the stock market, they haven't gone broad, they've gone narrow, and they've gone into some of these tech names.
Yeah.
Let's talk about what else we need to know this morning and figure out what is going on. Bloomberg has learned that Volkswagen and its Labour leaders are close to a restructuring agreement that will allow cost-cutting but prevent factory closures in Germany. According to sources, management is willing to keep plants running and reinstate job security agreements until 2030 in return for workers foregoing bonus payments. Additional cost-cutting measures may include moving Golf production to Mexico, ending VW branded electric vehicle production in Zwickau. The US Supreme Court says it will hear TikTok's challenge to a law that would ban the app in America next month if it isn't sold by its Chinese parent company, ByteDance. The arguments are scheduled for January the 10th, just a week before the ban takes effect on the 19th, so they're going to have to work pretty fast. Meanwhile, the EU has started an investigation related to concerns that TikTok didn't do enough to stop fake accounts and foreign powers from interfering with last month's Romanian presidential election. And President-elect Donald Trump is opposing a proposed stopgap bipartisan funding bill that will keep the American government open over the holiday period. Instead, he is looking for a pared-back spending plan that would also increase the debt limit. The move by President-elect Trump has been backed by Elon Musk, who has come out strongly against the stopgap plan put forward by the Republican House Speaker Mike Johnson. Johnson is now working on a plan B that would prevent a partial government shutdown as early as Saturday. So basically, Trump wants a bigger Christmas tree, but with less baubles on it, is the way that I'm thinking about this.
Pretty much. He's also trying to marry two very different bills with 48 hours until the shutdown looms, at a time when Mike Johnson has been trying to basically have a bipartisan bill. His reputation, the Republican Party's reputation to get this bill across the finish line depends on it. And at the end of the day, now he's adding in a debt ceiling story, which also kind of triggers what Janet Yellen can do, because she only has 20 days to put forward emergency powers that extends the debt ceiling into July. It's complicated because these are two separate issues that Donald Trump is trying to marry, again, with a 48-hour deadline.
And he's trying to do all this under the Biden administration, openly saying, let's just try and get this done. But the Democrats don't seem as if they want to play ball, saying, Republicans, a deal's a deal. You said you'd back this. And I mean, what's changed, Kriti? Take us to the headline.
I mean, what's changed is that we may actually go into a government shutdown on Friday, which was largely not priced in by markets and not expected just 24 hours ago, simply because he's also said that anyone who supports the bipartisan bill will basically be in Christmas spirit on his naughty list.
Coal for them. Musk has played a massive part in this.
Yes, he's not happy. Him and Ramaswamy don't like the funding bill.
They have come out aggressively against this. So many tweets yesterday, posts yesterday from Trump on the, from Musk on the back of this. Has he been the driving force? Has he changed the mind of the president and J.D. Vance to come out as strongly against this as they have done? I don't know, but certainly it was a tumultuous day yesterday on Capitol Hill.
Yes, one of many days over the next few years where we will be watching intensely the detail on Capitol Hill. Coming up on the programme, we'll focus in on the European auto space. European car sales fall again amid heightened talks of consolidation and union activity we will discuss. Plus, European leaders gather to discuss Ukraine and some of the top issues facing the continent. We'll be live in Brussels for you. And we'll be watching the yen moves very closely. Governor Ueda still speaking about policy. Some of the comments he's made around wages and waiting for more information on wages certainly weakening the yen. You can see we're down on the yen 1.1% now. He's also said there are risks to falling behind the curve, so maybe some of that weakness pairing, but we will continue to watch. If you have any questions for our guests, please get in touch. IB plus BBTV Go this Thursday morning is the way to get in touch with the team. This is Bloomberg.
What's the rush to keep cutting rates? Let's just back up a little bit. I think also they do have to listen to what's being talked about at Mar-a-Lago.
With this hawkish tone, this is sort of the perfect way for him to say, we're doing our job, we're looking at the data, it's coming in stronger, the economy's solid, and it justifies higher rates.
This is not going to be a great forecast for where the Fed's future forecasts have been, because they've been just so whipped around by short-term movements in data.
I think today's message was they have less conviction about that downward path of inflation.
Even with a 25 basis point cut, they maintain that level of restriction, and that they're still kind of being able to balance the risks assessment.
Some of the voices we've had on Bloomberg Television reacting to the Fed's decision, and more importantly, its forecast for fewer rate cuts next year. How have the markets reacted? Let's run through the action. Valerie, over to you.
Guy, a lot of the focus yesterday was this tension that the Fed has squarely put back on inflation. Their projections for next year are only showing 2 cuts for the Fed in 2025. The market has even taken that a step further and is now only pricing a 1 cut for next year. Powell also said in the Q&A that he sees that the Fed is entering a new phase in the rate cut cycle. That is central bank speak for the Fed, shifting gears and going on pause. Lastly, and maybe most importantly, on page 12 of the SCP, members see that inflation risks are now tilted to the upside, and this was a big swing versus September's SCP. If we flip on and just look at how that swing did captivate the markets, look here, back in September, only 4 members of the FOMC Council saw inflation risks weighted to the upside. Now it's 15 out of the 19 members saw inflation risks weighted to the upside as the market digests this new economic policies coming out of the Trump administration and a U.S. economy running above trend. All this also played out in the dot plot. If we could flip on and just talk about that. We did have one dissenter, Guy, but most importantly, she was joined by 3 others on the FOMC board, meaning 20% of the FOMC had their hands up, raised, saying, I don't think we should cut rates. We also saw in the projections for 2025 that there was 1 member who saw no cuts at all. So how does this play out in the market? We get a stronger dollar with the Fed pricing in less cuts for next year. We also had a Bank of Japan who is less in a rush to hike rates. It's playing out in dollar-yen perfectly. We're seeing dollar-yen weaken by 1% in this morning session.
Feels like it's our currency, your problem. Dollar strength pretty much across the board. Valerie, thank you very much indeed. Joining us to carry on the conversation, Yari Stein, Chief European Economist at Goldman Sachs. Euro dollar trading 103.98. Let's call it 104. Yari, good morning. What's your level of conviction currently for 2025? How certain do you feel about what is going to happen next year?
It's going to be a pretty uncertain year. I think that's fair. We're seeing a number of policy shifts. We've seen a number of data surprises. But I think at the core of it, though, we think there's going to be divergence between the US continuing to do well, slower rate cuts, but Europe still facing a lot of challenges, weak growth in Europe, and more rate cuts in Europe. And I think that basic theme in our forecast, I think we have quite a lot of conviction in. Of course, there are lots of open questions around policy, but that divergence theme, I think, and the strength of the US, I think, will continue to stand out.
How much divergence? How much divergence can happen if the Fed is, let's say the Fed goes on hold? How much further can the ECB go, or are these two unrelated conversations?
Yeah, I mean, they're not totally unrelated.
Yeah.
I think near term there's going to be some effect, for example, on the chance that the ECB does a 50. So I think, you know, there's probably some spillover into that, reduced urgency.
So we can take 50 off the table with the Fed doing what it's doing?
I think certainly for January, it seems pretty unlikely.
Yep.
I think, you know, it's still possible if you get weak data, but I think the 25s in Europe are clearly the base case. But I think ultimately it's going to be determined by the economies. And we have the US growing by 2.5% in 25. We have the euro area growing by 0.8%, you know, a big gap.
Yep.
And so I ultimately think the ECB will continue to cut. Of course, the exchange rate is responding, is going to take away a little bit of urgency for cutting. But then keep in mind, as was said earlier, it's really the dollar strengthening against everyone. And when you look at the trade-weighted euro, which is what really matters for the European economy, that has moved much less. And that's ultimately an important point.
Yesterday we heard from Jerome Powell talking about Trump tariffs, and this is something that all central banks globally are going to be dealing with in some way. His response to questions around this, acknowledging that some of the members of the FOMC are factoring in some of the Trump tariffs or planned Trump moves into their forecast, but then saying we don't guess, speculate or assume. I mean, we're all left to make assumptions, aren't we? Might go with a different name, but we're all left to make assumptions about what Trump's policies might mean for next year.
Yeah, absolutely. And our assumption is that we will get relatively targeted tariffs. So we think the Trump administration will impose tariffs on China and will impose targeted tariffs on the EU, mainly on autos. But quite importantly, I think, for Europe, is that the uncertainty around exactly what will happen will remain elevated. And we've seen in the past, in the first Trump term, we saw that this trade policy uncertainty was quite damaging for confidence, for investment, and is an important reason why we think growth in Europe will struggle in 2025. Whereas I would say on the US side, it's a little bit more about the extent of an inflation boost from the tariffs. But the growth effects are probably going to be more limited unless the administration goes in with across-the-board tariffs, which, of course, is a risk, but it's not our base case.
So if we do get that inflation uptick, as Jay Powell and his peers are preparing for in the United States, does Europe import inflation from the U.S. or import deflation from China?
Yeah, it depends on what exactly we get on the relative tariff sizes. And as you say, there are, in principle, from tariffs, two offsetting effects. You can import inflation through a weaker currency, and also, of course, if you retaliate against tariffs, so that would tend to push up on inflation in Europe. But against it, we think there's some slowing in demand as a result. And there could also be some trade diversion, as you said, from China, then essentially moving goods into Europe. And so that's why the European Central Bank has said, you know, we're pretty confident there would be a negative growth effect from tariffs, but the sign of the inflation effect is pretty uncertain.
Yeah.
And we think it's pretty small, probably, on balance in Europe.
Yari, we're looking ahead to the Bank of England today. The market has been on a big journey this week from pricing in 70 basis points of cuts in 2025 on Monday to now only 49 basis points or so. So not even two whole cuts, not quite. What's your expectation?
Yeah, I mean, today we'll get very little, I think. We'll get a hold with a large majority, probably 8-1. We think they will continue to say that they plan to gradually follow a gradual approach in withdrawing restriction, but that this will be based on the evolving data. So I think all of that is pretty clear. Main question is probably how they comment on the recent data. So we had very strong pay data on Tuesday. But we've also seen that some of the forward-looking employment numbers have weakened. So I think that's going to be probably the most important in terms of the commentary for today.
OK, really interesting. Some different signals coming through from the labour market. Yari, thank you so much for joining us. Yari Stern, Chief European Economist at Goldman Sachs. Coming up, we'll focus in on the Bank of Japan. Yen weakness, certainly a result of what we've heard from Ueda. This is Bloomberg. Welcome back to the programme. 7:30 here in London, 30 minutes before the start of trading in equities. And this is the futures picture. For the European story, we're looking at considerable negativity, but really pricing in what we saw stateside yesterday. So Euro Stoxx 50 futures down by 1.4% this morning. Interesting, though, if you look at US futures, NASDAQ futures and E-minis, they are showing a little bit of a bounce, but nothing compared to the losses we saw yesterday. So certainly it is still a catch-up trade for Europe that is in focus, Kriti.
Certainly, as we monitor that, we're keeping one eye on Japan as well. Still getting headlines from Governor Ueda out of Tokyo in that BOJ press conference, as you can see on your screen there. He's saying that they're going to talk about the risks. We already know that he's commented around the tariff risk out of the United States as well, saying that there's a need to be aware of that risk when making decisions. And strong easing means a constant risk of sudden inflation. Prices could shoot up if strong easing is prolonged. He also, I thought, made an interesting comment that he's going to give details of the Tamura proposal in an opinion summary. Just for our international audience, Tamura is a hawkish board member who's vouching for a policy rate up to 0.5%. The BOJ, as of today, at about 0.25%. As a result of all of those comments, you are seeing a pretty substantial move in dollar-yen trading now at a 156 handle, 156.59. Is where we're at. Let's get a little bit more context here and bring in our Bloomberg executive editor for Japan and Korea, Kazunori Takada, joins us this morning. A pleasure to have you on the program. Walk us through what the BOJ is waiting for before deciding on a hike. What does that timeline look like?
Yeah, thank you. So the governor was just explaining in the press conference that mainly two factors that he's waiting to see for more certainty before deciding on a hike. He cited the ongoing spring wage negotiation talks and certainties over U.S. policy, foreign policy, but mainly U.S. Economic policies. So the next timing, the next meeting will be held in January. The market is now expecting the move to the hike to take place then. When pressed about the timing at the press conference, the governor said that he was obviously non-committal to the timing, but he did say that that there will be more evidence that will be gathered between now and then, which would include, for example, some comments around the outlook for the spring negotiations from senior Japanese company executives, as well as potentially some indications of where President Trump will be thinking around his policies.
Morning. The yen is moving quite substantially on the back of what we're hearing from Governor Ueda. To what extent is the BOJ creating a problem for itself, in as much as the more the yen weakens, the more there must be pressure to hike to defend that, because that weak yen is not popular?
Yes, the yen has weakened about 1% on the day-to-day, and obviously increasing on partly because of the BOJ, but I mean mainly because of the BOJ, but partly because of obviously with the Fed, the outlook on the Fed from the U.S. It was interesting though. The governor was commenting about imported inflation, which obviously is reflective of the weak yen, and he basically said that on a year-to-year basis, the pace is somewhat maintained, which seems to suggest that he isn't that particularly worried at this point in time. However, as you know, the yen hit a 38-year low of 161 earlier this year. That's when Japan intervened. Should the yen sort of continue to fall further towards that level, I think obviously the story would change.
Yeah, really interesting. And some people were talking about that 155 level and saying, would that lead to verbal intervention? But as you point out, Kazunori, 161 was where we saw it last time. Bloomberg's Kazunori Takada in Tokyo, thank you very much. And just as he was speaking, the yen extended that drop, now down by 1.2% versus the dollar, the lowest since July against the dollar. But as we heard, it has been lower, of course. Let's get more with Joy Yang, head of Asia Economic and Strategy Research at Point72, who joins us now. Joy, nice to have you with us. Let's start with one of the questions that Guy was just discussing there. The yen really weakening once again. It's been lower, it's been at 161, but it's still weakening considerably. Not very popular in some parts of Japan to have such a weak currency. And also, of course, it can add to inflation problems for the BOJ. What kind of pressure is the BOJ now going to be under to hike at some point?
Yes, I can totally see your concern here. I think today at the press conference, Ueda has made it clear, in my view, that they have a preference to delay the hike towards March or even later because they want to wait for more certainty on Trump's policy as well as on the spring shuttle wage negotiation. However, between now and then, there's a very good chance, especially given that the Federal Reserve is now being more hawkish than we expected. If yen shoots back to 160, then I think the concerns that the imported inflation from a weaker yen could potentially become a dominant consideration for BOJ again. And if that happens before the January meeting, then I still see a chance that they might make a move in January instead of later.
Yes, I mean, do you see these comments around the spring saying we need to wait for more information on wages? Do you see that as reducing the chance of a hike in January? How has your expectation around January changed?
Yeah, actually, I think it does reduce the chance for a January hike if they prefer to wait for the shuttle wage negotiation result. However, I did notice that in previous years, the shuttle wage negotiation tends to be very backward-looking. This means the unions and also the firms bargain with each other based on their perception of inflation from the previous year, which is actually not some information that we don't know. They are not very forward-looking and trying to come up with an inflation projection for 2025 and bring that into the wage negotiation process. Maybe this process will change. Maybe the union and the workers will become more forward-looking as well as the firm. But at least up to last year, and also this year, shuttle wage negotiation, basically the negotiation is largely based on the inflation from the previous year rather than the forward-looking perspective. So I actually don't think that shuttle wage negotiation carries a lot of uncertainty, but BOJ seems to be very concerned and still wants to be cautious and wait for more information.
Well, Joy, it's Kriti in London. Aside from the wage negotiations, we know that Japan also has a major import problem when it comes to things like oil prices and other commodities that Japanese citizens need. If we were to see some of this tariff story result in things like higher commodity prices, how much of sway does that have on the BOJ's thinking?
Definitely, it will play a very big role because at least when BOJ moved the hike in July, they definitely think that the imported inflation, especially from the commodity price, energy price, because of the weaker yen, was a major contributing factor why they did a little bit rush in July, moved ahead with the hike. So I do think that, first of all, if we see yen weakens again, this is going to be a dominant concern for BOJ. But secondly, I think BOJ is also taking a slower step, and now they want to see it to be reflected in the data first before they pull the trigger. But so in any case, I think January is not completely off the table yet. But I think the preference, as explained by Ueda-san today at the press conference, is that they want to wait. However, the imported inflation is indeed a risk regarding the January meeting.
And he certainly mentioned that in the context of the United States and Trump, as you point out. But my thought goes immediately to China as well, because, Joy, I'm looking at Japan's largest trading partners. They have a larger trading relationship with China than they do with the United States. Is there a risk of importing deflation from China?
Well, this is a little bit hard to judge at this point because we know that Japan didn't really see real inflation until for the past 2 to 3 years. And a lot of that is actually driven by, first of all, it started with the COVID inflation. And secondly, it starts that the Japanese society is now becoming more flexible in terms of moving their prices ups and downs to fit into the economic cycle. And I will say that data still lacks evidence that Japan is actually importing deflation from China. But this is just something that we need to wait for more data to decide.
Joy, good morning. A line from Ueda. Prices could shoot up if strong easing is prolonged. What is the risk that we suddenly see a burst of inflation in Japan? Like, it could be imported, it could come from various different locations. But how big a risk is there?
I think the risk of that, in my view, is rather manageable. Because, as I mentioned, the shuttle wage negotiation, which drives the wage growth, and that has been a very important contributing factor to the inflation in Japan recently, that tends to be backward-looking. And when we look at the inflation this year, for 2024, obviously it has come down from the elevated level in 2023. So I do believe that wage growth, while it's going to continue to support a sustainable 2% inflation for the outlook, I do believe that the wage growth is going to decelerate at some point, especially for the second half of next year. And under such circumstance, I think the risk, the upside risk to inflation outlook, in my view, has somewhat reduced compared with 12 months ago.
We're going to leave it there. Joy, thank you very much indeed. Joy Yang, Head of Asian Economics and Strategy Research, joining us at point 72. Let's talk about what we've got coming up. European chip stocks may fall this morning. This after Micron posted disappointing revenue forecast. That's one of the stocks we're going to be watching. I think the broader theme today is a top-down rather than a bottom-up story when it comes to European equities. It looks like we are going to be sharply lower. This on the back of, obviously, the Fed decision yesterday and the big reaction we saw in US markets. We'll talk about all of that next. This is Bloomberg.
Welcome back to the opening trade, 7:44 here in London. Looks like we have some negativity ahead of us, of course, as we would expect, because of what happened yesterday on US markets post the Fed. We saw, though, that the S&P was down by more than 3%. So we're not expecting to work in all of that, Guy. And looking at US futures, I mean, they're flat to positive, as if there's some sort of line in the sand at least being drawn after yesterday's negativity.
So the question everybody's trying to figure out is, if the US catches a cold, kind of what does it look like for the rest of the world? And we've seen maybe some examples of that now. So the Nasdaq down by 3.5% yesterday. European equity markets down, but not down as hard. We don't have the tech component, so therefore, actually, where you've seen the concentration recently has been in tech. So that's where the bulk of the unwind is coming. So logically, in theory, Europe doesn't get hit as hard. Yeah. But if this move is sustained, does that gap kind of re-widen out, and actually the rest of the world does catch a cold when the US sneezes?
I mean, we're paying a lot of attention to a lot of the fundamental factors, but we should also mention that these are the last couple of trading days of the year. So I wonder how much of this is also just cashing out and rebalancing before the end of the year.
Yes, and a lot of people making that point after yesterday, saying it was the last big event. I mean, OK, we've had the BOJ this morning, but for a lot of US traders, the last big event, risk event of the year, and now, is that it? They've packed up, they've gone home. Hope they're still watching. Let's talk about the markets in 3 minutes. Our Markets Live executive editor, Mark Cudmore, is joining us. He's still paying attention to markets. I know we've got lots to say about the Fed, so let's do that, shall we, Mark? And then we'll come back perhaps to the BOJ. In terms of what the Fed has been saying, I mean, what stood out to you as overdone in terms of reaction to the Fed?
I think it shows the positioning that was out there because, look, we expected the Fed to be hawkish, and sure, they out-hawked our hawkish expectations, but not so dramatically. I think the only 2 cuts priced for next year, many people were speculating on an idea yesterday. I think maybe the dissenter was interesting because it shows there's a bit more controversial here. And ultimately, I think the scale of the reaction in the stock market reflects the fact that people are positioned very long. There's great complacency out there. We know that valuations are extremely stretched, and you've suddenly been given a reason to sell and take profit at this time of year. Why not just lock in those wonderful profits from this year, relax for a couple of weeks, and re-engage in the new year? And so I think it makes sense that we saw such a large reaction. And on rates, I still am not convinced the Fed cuts next year. I think there's a lot of uncertainty. I just don't know which way it's going to go, but I think we need more clarity on what Trump delivers in terms of policy and how that impacts before we can have any certainty which way the Fed goes. And I don't think there should be any conviction, though, that a cut is the next move from the Fed.
So, Mark, does that mean that if the big event was yesterday, that tomorrow's PCE and UMISH data is going to be a non-event? What do you think?
I think right now we're going to be trading positions and trading books and trading P&L. So it's not that it's a complete non-event, but yes, I don't think it's the big driver. I think right now it is going to be the market is going to be the news. If we go to the US session today and we see more weakness, that is going to encourage more selling. It's not the time of year where you get dip buyers. It's not the time of the year where the retail audience wants to engage. They're using their money elsewhere. They're on holiday. They're with family. They're distracted. They're spending on presents. It's not the time where a slide gets halted. So I don't even think we need much news. I think the price action is the biggest fundamental right now at this time of year.
Let's talk quickly about what's happening with Japan and figure out what is going on there. The more that Ueda sounds dovish, the bigger the move in the yen, the bigger the problem he has, and ultimately that might force a hike. Is that what we're looking at here? Is that the setup?
We were joking there that during the press conference, he was trying to, during the press conference, make the conditions where he had to hike by the end of the press conference by weakening the yen so much that he causes imported inflation. I mean, we're only partially in jest, but we were asking who hikes first next year, is the Fed or the BOJ? Again, partially facetious, but it really feels like the BOJ have stumbled here after kind of prepping themselves to kind of really engage this cycle. And they're not going to be hiking in January. They kind of pretty much said that. It's going to be pushed back. I don't know if they're going to get a hike in the first quarter. And again, then, for the Bank of Japan, we have to see what happens out of the US. We have to see what kind of trade tariffs actually get imposed. We have to see what policies come from that new administration. So there should be no conviction as well with the BOJ about what the next move is or when it comes.
The interesting thing here, Kriti, is that the US is creating a problem for everybody else. It's creating its own problems, and it's going to be really interesting to see how asset prices react and therefore how that ripples through the economy. But this strong dollar is starting to look like a massive problem. And you do wonder as well, we were talking about this earlier, whether this filters into Trump's thinking too. If you've got such a strong dollar, does that encourage him even more to deliver on the tariff front?
Yeah, so the strong dollar theme has been one throughout the Trump trade, right? And we've seen that throughout the election. It's been kind of in line with polling odds, et cetera. But it's the margin of the move that matters, right? So if you have these shock moves where you're going almost from 105 to 103 on euro-dollar, for example, in the span of less than 48 hours, that's the problem. I don't really know how you fix it, though, if you're not the BOJ and if you're not the Swiss bank and you can't intervene. What does the ECB do in that?
Well, the ECB sounds like it wants to do its own thing. Let's bring Mark back into the conversation. Mark, how big a problem is the strong dollar? How big a problem is the strong dollar for Donald Trump as he comes in as president? Are we going to see a more aggressive policy coming through from him? Because he's talked in the past about wanting to weaken the currency. He wants maybe to reshore manufacturing. He wants to make America great again. That's harder to do with a strong dollar. I know that sounds counterintuitive.
Yeah, absolutely, it's problematic, and I think this is why I think next year under Trump policies, again, we don't know what's going to be delivered, because he said he wants a weaker dollar, then he wants the dollar to be preeminent, he wants it to be strong, he's worried about it doesn't make it competitive. So he said many different things. So it's hard to know what his actual the substance of his policies will be delivered there. But yes, it is problematic. So I think the U.S. exceptionalism story is really going to an extreme in markets' point of view here in terms of the valuations we're seeing in stock markets and in the dollar, and they both tie into each other. They're similar tangents, and so therefore I ultimately think that in 2025, if you believe as I do that it's the end of US outperformance from the stock market, and I don't have high conviction that comes via greater correction in US stocks or via the rest of the world finally catching up, but I think part of that story comes with the dollar actually weakening, because an underappreciated element of the dollar story is this just long-term structural TINA narrative of inflows into US stocks because there is no alternative. If that gets undermined, either through weakness in US stocks that people see can persist, or because you get such a large discount elsewhere that's so ripe for a positive turn in narrative, either way, if people kind of going, you know what, there is an alternative, then you see stocks suffer and you will see the dollar suffer as well.
Great stuff. Mark, thank you very much indeed. Markets Live Executive Editor Mark Cudmore, LLIV Go, MLIV Go is the function on your Bloomberg terminal. Right, we're coming into the end of the year. Bloomberg understands that Barclays is set to increase its annual bonuses by as much as 20% after an improved year for traders and investment bankers. Will Shaw joins us on this story. Well, how different is this approach that we're seeing from Barclays? The rules have changed and it looks like Barclays is going to pick up on them.
It's quite a lot better. So if we look at last year, bonuses generally across the bank were down about 43%, according to the annual statement for 2023. The year before that, they were down about 8%. Now, in 2023, some bonuses got absolutely nothing whatsoever due to basically a slowdown in capital markets activity. If we look forward to today, what's going on, it's a much brighter picture. As you mentioned, traders are looking at 5% to 10% bonuses this year, increases. In equity capital markets and debt capital markets, it's even better, more like 10% to 20%.
All right, Bloomberg finance reporter Will Shaw giving us a little bit of good news on a fairly grim day for other markets, maybe looking forward to the bonuses story. Let's get to our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So chip stocks are in focus today after we saw this big drop in Micron in the US last night. That stock was down around 16% in the post-market. A lot of the weakness coming through in the personal goods and iPhone space. We will be looking at the likes of Infineon and also ST Micro, the ones that have underperformed this year, underperforming versus the chip machinery stocks. But given the moves we're seeing in futures this morning, we pretty much know these stocks are only going one way this morning. Then in terms of pharmaceuticals, a negative update on a drug for Roche. This was in Parkinson's and it has missed the primary endpoint in a key trial. The drug was seen to have potential sales potential of around $2.5 billion, but it was seen as high risk according to analysts. That stock done pretty well given the uncertainty around US politics at the moment. Then in terms of software, bit of M&A coming through worth around $1 billion. Software One is buying Crayon. Now this is a company listed over in Norway. The prices are at around 144 kroner, so it traded at 135 yesterday, so a nice bit of upside in terms of a premium on that one. Software One itself had a massive slump back in October given concern around its margins, so it does need a little bit of a boost. Worth keeping an eye on those software stocks later this morning.
Thank you very much, Joe. Joe Easton from our equities team with an update on where we are on these on those individual names. So we're waiting for something pretty negative at the start of trade, aren't we?
Yeah.
But looking at US futures, you wonder how long that's...
US futures are up a little bit. They're not up by a lot.
They're not undoing the losses of yesterday by any stretch.
No.
And we're not having another down day in the US, unless it doesn't look like that way.
So far. So we'll see exactly kind of what happens a little bit later on. It'll be interesting to see what the momentum traders do with all of this. Is there going to be any dip buying? It feels like actually maybe portfolio managers and retail are pretty long right now.
Yeah.
How much money is there extra to put into the market to buy dips?
Pretty still waiting for the data at the end of the week.
I'm
You're
still
here to the end.
I'm here till the end. I'm the last one standing. I actually think you're the last one standing.
I'm the last one standing.
Pre-Christmas. We should also mention that as we see a sell-off in stocks, we also see a sell-off in bonds in the European bond market, perhaps catching up to the move you saw in Treasuries yesterday as well. Pretty substantial one. We're going to cover all of that and more. Europe in the red this morning, down about 1.3% on Euro Stoxx 50 futures. We're going to break it all down. Stick with us. This is Bloomberg.
Thursday morning, good morning. Couple of minutes to go until the start of trading in Europe. We all know that European equity markets are going to be lower today. The Fed-induced sell-off that we saw stateside yesterday needs to be priced into Europe. But you think about where the rally stateside has been recently, and then think about where Europe is. That's where maybe the story gets a little bit more nuanced. I don't think we're going to see the same downside, but it was interesting that it's tech that suffered. Do we see that bleeding through into SAP? It's going to be interesting to see whether the frothier areas of the market are just limited to the United States. We'll see in a few minutes' time, but futures at the moment, Kriti, pointing a little negative.
A little bit of a catch-up, it feels like, already at play relative to what we saw in the States yesterday. Euro Stoxx 50 futures down a whopping 1.3%. Underperformance in France, as usual, as we've seen. A slight cushioning by the FTSE 100, Anna, but still down about 1%.
So that's the overall picture. Kriti, let's focus in on some of the sectors and individual companies in focus. From a sector perspective, jumping off Micron and the numbers after hours there that really weighed on that sector, we'll be watching what happens with chip stocks. And it was interesting that it wasn't the AI side of things at Micron that was weak. It was the more traditional phones, PCs, that side of the demand story that seemed to be the weak spot. So how much does that translate into Europe? Perhaps a little more clearly than some of the AI trends. European autos in focus. We had news out from European car sales declining 2% in November. France and Italy experiencing particularly sharp falls, while Spain actually saw a rise in sales. So we'll get to the auto names and see what that means. We've of course had a lot of autos headlines to do with M&A as well, so we'll get some analysis on that a little bit later on in the programme. We're also watching the software sector. IT business Software One is buying another IT business, Crayon. This is buying a Norwegian rival for 12.9 billion kroner, Guy.
OK, here we go. Time for the opening trade. Let's take a look at where we are going to be here in Europe this Thursday morning. We're anticipating a negative open. I suspect that's what we're going to get straight out of the gate for the FTSE 100. It is losing ground fairly rapidly as we start getting going with more stocks opening up. So we're down 2.3%. I think that probably accelerates to a 1% move. The IBEX is already down by 1.5% this morning. Where does this get priced the most? Are we going to see the names that have benefited from having US exposure getting hit the hardest here in Europe this morning, or is it a broader trade? Is there an FX factor that we need to roll into this story as well? Remember, the euro has lost significantly against the dollar as a result of the move we saw yesterday from the Fed. It's really interesting. The CAC's down by 1.3%, FTSE's down by 1%, 600's down by 1%, IBEX is down by 1.44, let's call it 1.5%. I'm really intrigued to see what the DAX does this morning. In so many ways, it's at the epicenter of the European story this morning. The car story is front and centre there. But you've also got names like SAP, which have really driven that market so strongly. Does it have an effect from what we saw yesterday in the Nasdaq? I think that's going to be interesting. Kriti, what are you seeing?
Well, the sensational six, your sensational six, not very sensational today. They are the weights on the stock 600 this morning from an index contribution perspective. Right on your screen across the board for the majority of it. I'm looking at only 17 stocks out of 600 in positive territory at the moment. And again, your biggest downside movers, Anna, from a weighting perspective is ASML, Schneider Electric, Novo Nordisk, and LVMH.
Feels fairly indiscriminate, doesn't it? When you look at all of the sectors in negative territory, every sector losing more than 0.3%. So even the more resilient side is down. Technology is the weakest performer. And to your point, Kriti, earlier on, it does seem as if we're seeing some read across, perhaps from the Micron story, into some of the players in the tech space, because it is that more traditional PC and phone story that reads better into Europe, reads more cleanly into Europe than the AI theme.
Do you think it's the Micron story? This feels like a... You look at ASML, you look at Schneider, SAP's down as well, Novo's down. It's the names that have got US exposure. It's the names that have done better recently off the back of the fact that they have huge businesses over in the United States. SAP has driven the DAX this year. It is down by 1.2% already this morning. ASML is down by 2.5%. Maybe that's the Micron story. But these are all names that have been at the centre of the concentration story here in Europe. And those are the names, therefore, you could argue maybe have done better off being kind of with having a US kind of flavour to them rather than maybe a European flavour to them. Yeah. Schneider maybe feels that kind of way as well. But it's interesting. It's ASML, Schneider Electric, Novo Nordisk, Asia Brown Boveri, Siemens, UBS is down a little bit, LVMH and SAP.
It's also, I think, worth saying, you mentioned that U.S. exposure, but the ripple effect of that dollar move, for example, is going to be on Latin America, on EM currencies. If you look at all the Spanish banks that are exposed to that have really been hit by the Trump trade as well, that takes a hit. And then, of course, that doesn't even start with the bond market.
Yeah, looking at the opening of the gilts market, UK bonds slumping at the open, 10-year yields rising by 9 basis points. And, Kriti, you were making the point before the break that we saw movement across, and this is, of course, as we're waiting for the Bank of England, but there does seem to be a pan-European move. I'm looking at Italy up 8 basis points, Spain up 7 basis points, the UK moving with the Eurozone periphery, it would seem. France and Germany up by 5-6 basis points. So it's everywhere, but more pronounced in the UK and in Spain and Italy as we factor in some of the moves that we saw in bond markets over in the United States. That global narrative around we're just not going to get as many cuts as we thought months ago.
So the mood today, sell first, ask questions later, seems to be the question. John Milton, head of global multi-asset strategy at JP Morgan Asset Management, joins us around the table. John, is that a fair assessment of the market moves, or is this simply just processing yesterday's turmoil?
Well, we came a long way, didn't we, in just over a month, if we think about the moves we've seen. And we got quite exuberant at one stage. And frankly, I think yesterday the Fed did a bit of a mark-to-market exercise. It basically said, OK, guys, you got very exuberant about how much we're going to cut rates. But you know what? Inflation's still something we care about. The economic picture looks pretty strong in the US. And the market, I think, has gone through a repricing exercise. Jay Powell yesterday actually admitted that some of the staffers in the Fed have started to calibrate a little bit in their expectations for what may or may not happen next year as the new administration takes hold in January. Yeah. So I think what we've seen really is just a little bit of cold water poured on what is otherwise a decent economy. And, I'm constructive about next year, and we're positioned accordingly. But trees don't grow to the sky. And this is one of those situations where the market perhaps have gotten a little bit ahead of itself. And, if I'm a bull, I've got to love a healthy pullback.
I love that you just said that. I have so many follow-ups. John,
I'm asking myself why they don't grow to the sky. But anyway, that's for a different show. It is entirely different.
We're Christmas Friday energy here on a Thursday. But John, what I think surprised me, and call me crazy, but I think what surprised me by the market reaction yesterday off the Fed is how baked into that bull market the Fed cuts were, especially when we're talking about a background of economic resilience, a background where Donald Trump's policies come from a position of strength that at the end of the day could benefit Americans who have the ability to digest a little bit more inflation, something that other global citizens don't have that. So in that context, why would a bull market really need Fed cuts baked into it to keep rallying?
Well, this is exactly the point. So, bear in mind, when you think about the basic Finance 101, your discounting rate goes up, then your present value goes down. So you've got to do a bit of a reset one way or another. But you're absolutely right. Equities, generate their earnings out of the nominal growth picture. You've got core CPI running at 3.3. You've got GDP now running about 3.2. This is a very healthy, strong economy right now, and we're expecting decent earnings growth across the index next year. The crucial thing is we're actually seeing it broadening away from those big tech names that we've seen really lead the rally this year. Doesn't mean that they're going suddenly into reverse, but it's just widening out. So I think what the market is starting to do is price, number one, a bit of uncertainty around the trajectory of inflation, which we heard from the Fed yesterday, will be a little bit shallower. They're not going to hit their 2% target until probably 2027. So the level of rates that they can cut to is obviously commensurately higher. That follows through. But the underlying picture on the US economy is one of decent nominal growth, and that's what's going to drive earnings.
And we've seen this, so the rethinking where rates go, it had a pullback effect on stocks in the States, and that's to be expected. There's a bit of read across into the European trade as well. We didn't go as high, but we're pulling back a little bit, down by 1.3% today. Where does that leave your expectations for Europe? Yesterday we had a guest on who was talking about actually a couple of things could change on Europe that could really change the narrative, could act as catalysts. One of them could be peace in Ukraine.
Yes.
Whatever that might look like, we'll leave that for another conversation. And another might be what a new government in Germany will do. Do you have any expectation that these factors change the outlook for Europe?
Well, I've been covering Europe for long enough to be used to being disappointed sometimes. But one thing I will concede is that the Eurozone tend to do quite well when there's a crisis. When they really need to get something together and actually change direction, they can move reasonably quickly. The issue that you often have is that we have to build a lot of consensus within the Eurozone. So you're right, the catalyst in Germany on the 23rd of February is a significant one. But it'll take a while to form a coalition. It will then take a while to decide how to actually move away from things like the debt brake, the black zero policy. And we've heard Merz coming out saying, that's not on the table right now. So the idea that we get a sudden reset in terms of fiscal support in the Eurozone, and there is dry powder through the Next Gen Fund, make no mistake, that could be a little while yet. But Europe is certainly pricing inexpensively if you look at it relative to the US. But it's worth bearing in mind, the Eurostoxx is trading at around 14.5 times PE. That's half a turn below its sort of long-term peak. So it's not actually cheap internally.
Are the factors I cited, Ukraine and Germany, and the fiscal impact that might have, are they enough to change the narrative on Europe, or do you need something else? Because there's a lot of talk about, just structurally, Europe isn't set up for the new tech era, for example. Do we need something else?
Well, I'm not sure. I think there's a couple of things to consider. Look, Europe doesn't have a solvency problem anymore. Certainly not that we can see. It has a growth problem. It's an ageing economy that's had very little sort of impetus onto its consumers. The European consumer just doesn't, unlike its European, US counterpart. So you don't have that big sort of boost. And secondly, global growth has been a problem in the goods market. So we've seen that slow down. You see that in the difference between services and goods inflation. So without that, and with a block which is geared very much to the goods economy, it's going to be slower. But make no mistake, and we all pray for this over the holidays, I'm sure, which is that we get a peace in Ukraine. That will remove a major left tail risk. And under that circumstance, you can see a significant repricing of risk. But it doesn't go anywhere to addressing Europe's underlying growth problem. That's going to take some fiscal involvement and a little bit of impetus from governments really getting their heads together.
Can I kind of fold that into a conversation around the S&P and the equal weight? In theory, you'd have expected the equal weight to do better, i.e. you'd see money coming out of tech stocks, and as a result of which the equal weight would outperform the S&P. That didn't happen yesterday. In fact, it hasn't been happening for a while. This whole idea that we're going to get this broadening market has been sort of blown up over the last few weeks. Why does that trend reassert itself? And if that trend does reassert itself, does Europe get any of the crumbs from the table as a result of that?
So I think we've got to look at the whole context. I mean, we did have a big outperformance of small and mid, and it's basically given it all back as we've repriced the rates. So we're not in any worse position. I think what we saw yesterday was a de-risking event.
Sure.
And so, we're coming into a thin time of the year. We've got triple witching on Friday. After that, markets are going to be thin. If you want to be out, this is the time to do it. So, to my mind, this feels like a sell-off of some exuberance. But a couple of things I'd say. First and foremost, if we look at the sort of likely pathway of fiscal support, tax cuts, potentially the issues with some deregulation, that leans more to the small and mid-cap area. And so we like broadening out. We think that's a theme for next year. The second thing I would argue...
Why didn't it work this year?
Well,
because I heard that commentary earlier on this year. We're going to broaden out. The market's going to broaden out. That's what's going to happen. It happened and then faded really quickly. A lot of people got burnt. Why are you more convinced that it happens next year than it would have done this year?
Well, I think a few things. I think if you look at the sectoral mix, I mean, what's been rewarded in the US has been quality. You've had quality earnings from the big tech firms.
Yep.
That's been rewarded in what was an uncertain environment as we were going through a Fed reset. You didn't have necessarily the same growth stimulus that's coming through, even though we've had a very strong...
But we're going to see huge amounts of uncertainty next year. Why wouldn't I just sit in big tech?
Because I think you're getting a very strong pickup in terms of the fiscal impulse that's expected to come through. You're getting much more sort of inward-looking policy, which I think supports some of those firms. So you're getting a situation where I think you've got some more certainty, some broadening out, some extension of the cycle. So that together, I think, gives you a reasonable support for small and mid. This is not a world where we're thinking that we see the big caps and the tech firms suddenly go into reverse. I'll give you an example. This last year, we've seen 40% earnings growth in the Mag 6 firms. Next year, we think we'll see 22%. This year, in the other 494, we saw 3% earnings growth. Next year, consensus is expecting 13, and that's because of a broadening out, a pickup in the goods economy, reacceleration in the housing market, etc. So all things which will benefit the broader economy, not just those high-quality cash compounders, which, frankly, are what the big tech firms are.
Great to see you, John. Have a great new year.
See you too.
Thank you very much indeed. Have a happy Christmas as well. John Bilton, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. As was pointed out a little bit earlier on, the Core 6 is not looking very clever this morning. Let's take a look at what the numbers look like. As you can see, it is a sea of red out there. Even the relative safety of Nestlé this morning is seeing some downside. But as you can see, big cap tech in Europe, the kind of core of the market, is certainly under significant pressure. What else are we watching? Joe Easton has the details.
Going to start in the tech stocks, Guy, and as you say, not looking too clever, that you could say about these chip stocks. Seeing some real weakness in the smaller names, particularly Strong, also VAT, Infineon as well. Now remember, it's a double hit from the Fed and also that warning from Micron. That stock dropping around 16% in US trading and weighing on these stocks in Europe as well today. Then in terms of pharmaceuticals, two stories going on there. Firstly, Roche declining after that Parkinson's disease drug trial that did miss primary endpoints, according to a statement. We're seeing the stock coming down 2%. That drug does have $2.5 billion in estimated peak sales, but it was seen as high risk for that one. But another pharma stock going the opposite way entirely is BioArctic, absolutely soaring over in the Nordics today, up 29% at the moment. The company has announced a pact with Bristol Myers Squibb on one of their antibody treatments in the US, so getting a big payment in terms of some milestone payments that could top around $1 billion, according to a statement on that one. Then in terms of software, we have got that M&A Software One buying Crayon. Now Crayon, seeing that one a little bit lower this morning, to potentially we're waiting for the move to come through in that one. But Software One actually bucking the trend of the downturn in tech this morning. Investors getting excited about the potential benefit of this M&A, so that one going higher. Then closer to home in terms of the UK water stocks getting a boost because Ofwat has announced the amount of money that can be charged for water bills. Not good news for all of us that have to pay water bills, of course. But in terms of the stocks, they're going higher. Severn Trent and Pennant, actually a couple of the best performing stocks on the entire Stocks Europe 600 today. Kind of tell you how many stocks are negative given the moves from the Fed. Then in terms of rating changes, UBS has a big note out on insurance today, and they've downgraded a couple of stocks. They put a sell on Zurich, which is an unusual rating for that company. This is all due to valuation. The positivity around insurance premiums is factored into the price, and that one is declining 1.7% this morning.
Joe, thank you. Joe Easton from our equities team with a briefing on those stocks that are moving. We are watching live pictures coming to us from Brussels. EU leaders are busy arriving in Brussels for a summit that is taking place there. We've seen Ursula von der Leyen arrive, Viktor Orban arrive. We just saw the Greek Prime Minister Mitsotakis getting out of his car as well. So we know they are on their way. We will be in Brussels shortly. Oliver Crook live from that EU Leaders Summit next. This is Bloomberg.
Let's call it 19 minutes into the equity market session. This is what equities in Europe look like. This is what the indices look like. We are down across the board. London maybe getting a little bit better, but most markets are down by, let's call it 1.3%, looking a bit better maybe. Technology, financial services, real estate, the three big sector losers. You certainly saw real estate under pressure over in the United States yesterday. If you're looking for some safety, you find it in groceries this morning and in the food and beverage sector. But even the food and beverage sector is down by 0.7%. Every single sector in Europe is under pressure. Alice Weidel is the first ever Chancellor candidate from the far-right Alternative for Germany party. Let's move on to German politics. The party is currently second in the polls ahead of the country's elections, which are now taking place in February. In an exclusive interview with Bloomberg's Oliver Crook, she slammed the EU for undermining the country's auto industry and calling for a German exit from the bloc.
We don't see that the European Union in its current state is an institution that is working well, right? So what we need to have is free trade among the European countries, but we don't need all the bureaucracy. So, example, the European Commission, which is actually not voted, right? So you have a executive power like the Commission with also legislative power. That is not elected. So this is a huge democratic deficit. So this commission decided just to forbid diesel and benzene, like all the traditional fossil motor, right? So what happens is that they actually ripped off the German automotive sector.
Many people are critical of the EU on many of the points that you make here, but very few are making the case for withdrawal from the EU, and specifically on the euro. How do you envision that happening? Was it a return in Germany to the Deutschmark? Is it then? Explain to us the mechanics of how you imagine that working if you had your way.
Well, this is the entire discussion around the Dexit, right? Yeah. So we think that the European treaties need to be reformed so that every country within the European Union has a right, first of all, to have a veto against the Commission. For instance, that the German government could say, okay, we don't agree, we say no. Mm-hmm. So the veto power in the European treaties. And if a country wants to leave the European Union, why not falling automatically into a free trade zone? I highly recommend just a free trade zone, because all the bureaucrats, thousands of them, like eating up taxpayers' money, they just disturb real competition among the European countries. We don't need all of these bureaucrats that have actually who have no clue what they're doing and destroying our foundation in the European Union.
The view from the AFD. Interesting line, given what happened with Brexit and the kind of hard Brexit that ultimately was delivered. Let's turn our attention back to the EU's Leaders Summit, which is taking place in Brussels. We've been seeing some arrivals over the last few minutes. Ollie is there for that as well. Ollie, what are we looking for?
Yeah, so listen, Guy, I think it's really interesting to talk about that sort of interview with the AFD in the context of what European leaders are dealing with here in Brussels. I mean, the AFD, again, is one of these far-right parties in Germany. Many of the far-right parties, like Le Pen, have abandoned this idea of exiting the euro, of exiting the EU in order to become more palatable and gaining sort of presence and political power. The reality of the situation is the AfD will not have direct political power because they will not be able to join a coalition. They've been boycotted from everybody in the German establishment. But as the #2 party in Germany, arguably the #1 country of the EU, for this conversation to be present is something that just is added to the list for European leaders to worry about here. And at the top of the list for European leaders, I say there's really three big issues. I think the first one is the elephant in the room, which is basically the dysfunction within Germany, within France, and the difficulty of getting anything done in that context, particularly at a time when you need immense political will in order to enact the Draghi agenda. The other question is, of course, Ukraine. We're waiting for Zelensky to walk in any minute now. I'm speaking to European leaders. But again, on this issue, there's very much a sense that basically the Europeans are kind of paying for some of the gas, but they are not driving the car. And that comes to the third issue, which is really Donald Trump. This is the final meeting before the inauguration of Donald Trump in January of next year. So the question is, how much Trump-proofing is there going to be going on behind the scenes? I spoke to the Luxembourg Prime Minister about this yesterday, and really, frankly, all the leaders I've spoken to have been very reticent to have any sort of opinion on Trump, very much wait and see. But the reality of the situation is there's a sense here that this is an EU really in the back seat, and they really need to sort of come together after they have sort of resolved many of their own political domestic issues, which, frankly, we don't see happening anytime soon.
OK, Oliver, thank you. Bloomberg's Oliver Crook there. Now, clearly, defence part of the conversation. This takes us on to our next discussion. NATO Chief Mark Rutte is calling on allies to ramp up defence spending to prevent a future war with Russia.
We are not ready for what is coming our way in 4 to 5 years. We can prevent the next big war on NATO territory and preserve our way of life. This requires us all to be faster and fiercer. It is time to shift to a wartime mindset and turbocharge our defense production and defense spending. Russia is preparing for long-term confrontation with Ukraine and with us.
Some of the words we've heard recently from Mark Rutte. Bloomberg Economics and Government Editor Tony Halpin joins us now, and I know we put some spotlight on this story at Bloomberg News today, Tony. How are European leaders then responding to what they see as an increasingly serious security threat from Russia as they gather in Brussels?
Yes, it's a very mixed picture because many European leaders in the east of the continent have been warning for some time that the threat from Russia is rising, and some of their complaints towards their Western European colleagues is that they're not taking that threat seriously enough. As you just heard, though, NATO is now warning very clearly that European governments need to do more. They need to respond to what's viewed as a campaign of hybrid attacks, sabotage, interference in elections that are intended to undermine confidence in the governments of Europe and to undermine European efforts to defend themselves against what is seen now as an aggressive Putin regime, battle-hardened and with a war economy that's churning out vast amounts of armaments.
All right, Bloomberg's Tony Halpin, we thank you so much for walking us through, of course, that crucial story. The Russian security and that defense story very much in focus, as, of course, Tony and Oliver both really talking about it. It's also certainly something that's going to be discussed later today when we speak with the U.S. Secretary of State, Antony Blinken, about not only Ukraine and Russia, but the Middle East as well, the foreign policy transition under a second Trump administration when it feels like a lot of people, both on the fiscal side and the monetary side, really standing on the sidelines, waiting to see what those policies look like before acting. It was certainly a theme both in Governor Ueda's comments and, of course, in Jay Powell's comments as well. We'll likely see that in the BOE. That interview coming up at 1:15 p.m. London time. Stick with us. This is Bloomberg. And we are getting breaking news from the Riksbank out of Sweden. They are cutting their policy rate to 2.5%. The estimate was 2.5% as well, cutting by about 25 basis points. This is their fifth rate cut this year. Not a ton of movement in the Swedish krona against the euro or against the Norwegian krona as well. The crucial bit here is that Sweden is viewed as the major Western economy with the least amount of purchasing power. So those currency moves are going to be crucial, but perhaps already baked in. We're also 30 minutes away from the bank decision as well. Simply this idea they are the most hawkish outside of the BOJ. I think this is a fascinating one to be watching because they kind of have their hands tied. They don't really know how to stimulate the economy.
Yeah, this was one of the central banks, and there weren't many that we were waiting for actually deliver a cut this week, and they have done, just as the Fed has done. But they are also giving some guidance on 2025, and they say they may be a cut once again in the first half of 2025, so a little bit more guidance there. They see risks linked to economic recovery and also around the krona rate. And we saw just yesterday the government actually downgrading their growth estimates for the Swedish economy.
Well, they're doing the same thing. So for 2025, they've downgraded the estimate from 1.9 to 1.8%. So that's the GDP growth target for next year. 26, they've upgraded it a little bit. So they're pushing that growth story out a little bit further on. Not much reaction in the currency. As you say, maybe one more cut coming. Are they done at that point? Is that as far as they ultimately need to go? This feels very priced in terms of the narrative. And as you say, we've already seen a front running of the GDP forecast changes coming out of the government.
And it feels very priced. And Kriti, we're watching a tale of two Scandinavian banks today, aren't we? Because this priced and what is priced for 9 o'clock in a half an hour's time is for the Norges Bank to do nothing. And that seems to be something that we're also widely expecting.
Widely expecting that, but also watching some of the M&A front as well. And I make that connection simply because on the one side, you have these policy decisions that could change the financing rates for some of the M&A stories in Europe.
Does Volkswagen benefit from a weaker euro? Is that a story that could help it ultimately next year? Or is its geographical footprint so big that actually its currency hedged just physically as it works its way around the world with the number of plants that it's got? Germany is the focus of attention, though, right now. And Bloomberg has learned that Volkswagen and its Labour leaders are moving closer to a deal, maybe to restructure the automaker's namesake brand without shuttering factories in Germany. Let's get some analysis on what is happening here and what the wider implications are. Bloomberg's Craig Trudell leads our autos team. Patrick Hummel, head of autos European research at UBS, joining us around the table and also down the line. Craig, I want to start with you, first of all, just to bring us up to speed with where we are with the news surrounding this Volkswagen deal with unions. How close are we? What does it encompass?
Yeah, this was a scoop overnight from Monica Raymond in our Berlin office. This has been dragging on for weeks now, this attempt on the part of management to really significantly restructure their namesake brand. This is years in the making in terms of structural inefficiencies, overcapacity. We've seen time and again Volkswagen try to rationalize, really make efforts to bring some costs down. What they've repeatedly run up against, of course, is the structural challenges that they have with the labor position, sort of left, right, and center, really being a bulwark against having to make tough decisions. And so what we're hearing is that there may be some give in terms of what workers are willing to give up in order to keep plants open.
Patrick, let me come to you. We've seen the European data this morning in terms of auto sales. It continues to look fairly grim. Let's figure out whether or not Volkswagen is going far enough. Is a deal with the unions in Germany to keep Germany open, to not see factory closures, the right way to go for this business?
Lukewarm to us, to be honest, what we've been reading overnight. And we're not sure this is really the final package, and this is something management can agree on. Just forgoing bonuses and keeping all plants open, reshuffling product a little bit, that's not saving you 4 billion euros a year, but that's the number the company needs to at least get closer to the margin targets. And there are lots of headwinds. It's the weak demand situation, as you rightly mentioned. The European CO2 compliance framework is a headwind for the company. So we don't think the measures that were mentioned overnight in your article are going to be sufficient to get to the 4 billion savings.
So that's interesting. So, yeah, to the point you were making, Craig, this is sort of, a step on the way. But as we were just hearing there, maybe not the final final arrival point for VW. We've had a lot about consolidation, and we talked yesterday about Japan, a lot about consolidation this week. We talked about the news from the Japanese automakers. And then overnight, this develops even further. Foxconn in talks with Renault to perhaps buy their share of the Japanese automaker. How is this developing? How more likely or less likely does consolidation in the Japanese space look now?
I think this is a fascinating story. With Renault, of course, they have a significant stake in Nissan, almost 40%. Some of that is held up in a trust, just to add a little bit of further complexity to the matter, where Nissan has the right of first refusal if and when there's further selling down of that stake. But if you're in Renault's position, of course, you want the best value for those shares, and so these reports just in the last day and a half that not only is Honda interested in potentially merging with Nissan, but Foxconn also being interested. You want to play that out a little bit. You want to entertain not just Honda but also Foxconn's interest and get the best value for your stake. I think adding to the intrigue here as well is that at Foxconn you have a senior executive kind of leading their automotive efforts who is a former Nissan executive, and so there's a lot at play here, and some opportunity for Renault to kind of find an exit for this very substantial stake that is quite depressed because of the challenges that Nissan has been having.
Yes. Patrick, I know European automakers are your focus, but what interests you about these Japanese developments? Is it the fact that Renault gets brought into this very quickly because of the conversations that Foxconn is now having and the stake it holds in Japan? But also, does it set any kind of thoughts running in Europe about further consolidation as a way to take on Chinese and Tesla competition?
All right. First of all, we have to say the Japanese industry is not as consolidated as the European or the North American one in terms of numbers of players in the market. Europe and US are much more concentrated. The immediate interest in that potential Honda-Nissan deal is, of course, from Renault's perspective as a shareholder. Renault is often mentioned as a candidate also for consolidation in a wider context because it's a relatively small player. It's the smallest remaining mass market player in Europe. I can't comment on specific deals or likelihoods or anything, but it's clear that the industry is going through a rough phase. It is an industry that is suffering in terms of margins. Pricing power is eroding. There is new competition emerging, and it's still an industry with a very high capital intensity. So in the end, consolidation is the answer to address these challenges, and let's see how this unfolds.
Well, Patrick, we're talking about wage negotiations as well in the auto space. We're talking about it in the context of Volkswagen. We're talking about it potentially in the context of a merger in Japan if this deal were to come through. It's certainly been a topic over in the States as well. How much of that is the conversation in 2025 when it comes to the bottom line for some of these European automakers?
Right. I mean, first of all, yes, there is a necessity to restructure, and we see lots of headlines on the OEM side, but also numerous tier one suppliers that are in restructuring mode. I think, first of all, the implementation cost of restructuring, especially in Europe and Germany, are quite high. So you better be prepared for significant cash outflows to make these headcount reductions happen or even plant closures. Second, these self-help stories, they take time, but there are lots of headwinds to earnings coming from the pricing environment, the competitive environment. I mentioned CO2, so that, seeing a positive bottom line impact really of the restructuring will take quite a while. And meanwhile, the cash flow situations of these companies won't look great because of the implementation costs of that restructuring. So when we published our outlook for the sector a couple of weeks ago, we painted a quite cautious picture, and the fundamentals are likely to deteriorate, and we find it way too early to say, this is now a sector you can buy just on the restructuring, on the self-help stories.
Yeah. Patrick, we were hearing from the AFD leadership just a few minutes ago. Our colleague Ollie Crook has been talking to them. There is huge pushback from the AFD suggesting that we need to see rules change, that the government isn't supporting the auto sector, that part of the problem the auto sector is having in Germany is down to politicians setting unreasonable targets for the sector to reach. How big a catalyst would it be if we start to have a serious conversation about changing some of those catalysts? Like every month, month after month, it gets harder and harder to get there. Are we going to have to change the rules ultimately, and when do you think that may come?
Right. The EU, of course, is the main body here. And in the end, there is a new 5-year framework for CO2 compliance that starts on January 1st. That's going to be very tough for the industry to meet. There have been lobbying efforts, obviously, from the industry, also some EU member states that push for a change in the rules. There is a proposal out there that to us looks like a quite possible outcome, which is basically giving the companies more flexibility. They would still have to achieve the CO2 goals over the next 5-year period, 2025 to 2030, but they would not have to be fully compliant in year one during that 5-year period. They could also overcompensate a shortfall next year in the following years, and that would give the industry more flexibility. You would at least avoid the risk of immediate big fines for the industry. You would avoid expensive pooling agreements with companies like Tesla. So in that sense, that would help the industry. But of course, it would not remove the pressure to boost your EV sales, and the EVs are still not as profitable as the combustion engine vehicles. So in that sense, we would still see a dilution of EBIT margins of the OEMs.
So, Patrick, stay with us. Craig, I want to come to you here. He's talking a little bit about the margins and where that wiggle room actually is. Where is it, given that we're also kind of having a little bit of a race to the bottom in terms of capturing specifically the American consumer as well? Where is the wiggle room for some of these car makers?
Yeah, I mean, I don't think there is much, unfortunately, is the sad answer. And when we talk about, I think we led into this conversation talking about, currency and potentially a weaker euro maybe being, reason to lift these companies. On the other side, you have these, countervailing pressures of say a Trump presidency and increasing protectionism and tariffs where, in the past, maybe you could have taken advantage of a weaker currency and shipped more Porsches and Audis to the U.S. market. I don't necessarily see that being, much of an option if the first Trump administration is any guide. When we often heard Donald Trump talk about, lamenting how many Mercedes he sees on Fifth Avenue and, how few Cadillacs and Lincolns we see in Germany or France. And so this is an industry that really is under pressure from a competitive standpoint. I think, the rise of China, of course, is bringing so much to this, but also just the fact that, we're not seeing, as we've seen again this morning with Europe car sales, we're just not seeing growth. And it's not that sales have, fallen through the floor. It's just that we're not going to see, a whole lot of upside from here in terms of expansion for this industry.
Craig, I know there's a serious point there about tariffs, but it does make me reflect on the size of some of those American vehicles that you're talking about, whether there's space for them on any of our roads. Patrick, let me come to you finally. Craig talking there about tariffs, and that, of course, as we look at 2025, is a big unknown for many industries, including this one. What do we need to know about those that are cushioned from tariffs because of localized production to a large degree in the United States?
Right. You have, of course, and you mentioned the German luxury car makers, a very large U.S. footprint of BMW and of Mercedes as well. So they look to be more cushioned, as you call it, against tariffs, but they still would import their highest-end vehicles into the U.S., like Mercedes S-Class, BMW 7 Series. These models are still made in Germany and could be subject to tariffs. But clearly, BMW Mercedes would not be as affected as Porsche, that has 100% of its production in the EU. And then we need to see what happens with Mexico and Canada. Obviously, for the time being, I think the market prices it as a tail risk, not as a base case. But also on that front, the European OEMs, the Germans, would not be completely immune. Both Mercedes and BMW do have a Mexican footprint, so does Stellantis. So these are important potential risks that are currently not reflected in earnings estimates.
Thank you very much for joining us. Patrick Hummel, Head of European Autos Research at UBS. We thank you very much for joining us. And Craig Trudell, of course, Bloomberg's Craig Trudell, joining us around the desk here. We have movement in currencies, Kriti.
We do. A quick check on dollar yen here. It did hit that 157 mark. Crucially, we started off the day hitting at 150, I think 154 before Governor Ueda started speaking. It was already seen some pretty substantial moves. The weakness continues, a little bit of a snowballing effect, even though you're seeing strengthening in the other currencies that were hit by that dollar move. Euro dollar at 104, cable at 126, but the pain in the yen does continue. Coming up, we're going to pivot to the UK. Traders looking ahead to the Bank of England's rate decision amid stagflation concerns. We're going to dive into what we can expect next. Stick with us. This is Bloomberg. Welcome back to the opening trade. We're about 48 minutes into today's session. You're playing a little bit of a catch-up trade in terms of the risk sentiment that we're seeing. We saw a major sell-off in the States. We're seeing a major sell-off here as well, down about 1% on the stock 600, and the other individual indexes across the continent not far behind. Underperformance in France, which continues to be a major theme, and Italy, I should mention, down about 1% as well. We also are seeing a sell-off in the bond market as well. Some of that is being a little bit of a catch-up trade to what we heard from the Federal Reserve, a little bit more of hawkish sentiment there as well. To me, what I think is interesting is that there's also been news out on the fiscal side. Donald Trump talking about merging what was almost a done deal, almost consensus bipartisan bill in Congress to avert a Friday shutdown for the U.S. government, now kind of getting married with the debt ceiling conversation of next month.
What happens if we do see a government shutdown? Like, how do markets react to that? Is this seen as being a sort of tactical story, i.e. Trump comes in and fixes it? Great, we're going to get the deal done at sort of the beginning of next year. How long can it last before we're talking about major damage? Yep. Musk was talking about no damage, virtually no damage coming to the US economy. But that stands in stark contrast to the data that we've seen in past shutdowns, which actually can be meaningful if they last. Especially,
if they last. And this is also at a time of a transition of power as well. Yeah. So you have basically the debt ceiling limit hits January 1st. Janet Yellen has 10 days until the other kind of trigger that happens. It gets a little bit nuanced. She has 10 days to create extraordinary measures, basically, that the Treasury Secretary deploys. It pushes the problem out till July, but then 10 days after that, she's not Treasury Secretary anymore. Yeah. So Scott Bessent basically inherits this problem, not to mention the government could be shut down the entire time. And to me, what I think is staggering is that we've been paying so much attention to the central bank story in terms of the impact on the bond market. The 30-year is what trades off of the deficit concerns, and that's where perhaps the market isn't pricing in the chaos of the next 48 hours.
OK, we'll certainly watch to see how this one develops then, Kriti. In terms of what we're also watching out for today, 12 o'clock UK time, the Bank of England with a rate decision, 1:30 p.m. UK time, US jobless claims. We do have some data. Is anybody in the States still watching, after the Fed decision? I know, Kriti cares. Well, we thought until the end, but actually she's done after this week. So, will you...
It's really you.
Yeah, Guy cares. Next week, Guy cares.
Am I doing your job?
Do I?
FedEx earnings, we get those. Nike earnings, and they are in focus. Well, nice reading on the consumer, nice reading on global trade as well, sometimes out of FedEx. And, some early alarm bells come from that sector on occasion. So always worth watching. And we have Micron numbers, which certainly got our attention overnight. Looking ahead then, the Bank of England stands out as one of the things around lunchtime here in the UK that we have to pay attention to. We're joined around the table by Bloomberg's Valerie Teitel and Dan Hansen, Chief UK Economist at Bloomberg Economics. It's been a busy week for UK data. It's been a busy week for Dan Hansen, who's been here almost every day, I think, talking us through the journey we've been on the UK narrative. So where has that left us then, Dan? We saw actually a pullback in expectations of rate cuts in 2025. From the Bank of England because of the strength of some of the data.
Yeah, we have. We've had this. I mean, it was all on the wage data. Yesterday, I think there was a bit of consolidation. Obviously, we've had the Fed overnight, but it was all about the wage data and that overshoot. I mean, one thing I'd highlight as well is that CPI overshot the bank's forecast. It didn't overshoot consensus expectations. But I think going into today, and if you sort of take yourself back to what the bank was saying in November and what has been said since, obviously we've had the data over the past week. The bank was looking at the sort of median expectation on the MPC was for 100 basis points over 2025. We're at 50 now in the market. I would be very surprised if the bank came out today and said something vastly different to what they said in November and sticking to the sort of this idea of gradualism. So they tend not to push back against market expectations, particularly when there isn't a press conference, because it can be...
And there isn't today.
And there isn't one today, and it can get misinterpreted when they put it into the minutes. People just get it wrong. But I think there's going to be this sort of tension between what the bank thinks is going to happen over 2025 and what the market thinks is going to happen. And there is definitely going to be
How divorced is bank thinking from Fed thinking?
It's an interesting one, isn't it? Because we have 50 from the bank this year. We're going to have had 100 from the Fed this year.
Yep.
If next year we have 100 from the bank and 50 from the Fed, if the dot plot's right, N25, they're in the same place. Now, one thing I think I was talking to Fran about this yesterday, that I think the end point of the cycle for both is going to be quite similar, predicated on the idea that the economies don't fall off a cliff, which, we're sort of here in the UK.
Reassuring.
We're here in the UK, we're sort of teetering on the edge, and we feel like we go from quarter to quarter worrying about a recession. But I think the end point, the sort of neutral rate, the Fed's still sort of talking about this 3% number in its long-term projection. It feels like it's going to be quite a bit higher than that to me. And I think both will end up somewhere between probably 3.5 and 4 at the end point for their cycles.
Well, Val, hop on in here because as Dan was speaking, I'm just looking at the gilt market. You're looking at a 7 basis point move on the 10-year today. Is this simply a little bit of a reaction to what we saw from Chair Powell yesterday in the pretty big move we saw in the Treasury market, or is there something else to it?
No, look, I mean, the gilt market has been trading weak this week. I mean, fixed income globally has been trading very poor in the last 2 weeks. A lot of this reaction in gilts is due to that big rise we saw in the Treasury market yesterday with yields across the curve higher by 11 basis points. I mean, that was all due to the fact that Jerome Powell really put the emphasis squarely back on inflation. The risks tilted to the upside that we saw the members worried about in the SEP projections really, I guess, catching our eye today just how concerned the Fed is about this uptick in inflation. You guys were just talking about the possible government shutdown and all that confusion that plays into policy coming next year. We know there has been a hit to growth that has come out of previous shutdowns. And Powell spoke specifically yesterday saying policy uncertainty plays into inflation uncertainty in both directions. So a lot of this overhang, you know, it's not going to be gone anytime soon. I know we want to close the books and head up to Christmas break.
I still want some more volatility. I'm not quite done yet, so a bit more news would be good.
Monday, Tuesday?
Monday, Tuesday would be great. Big events on Monday and Tuesday would be fabulous.
Just so we can fill the show. That's always helpful. I mean, Valerie, I mean, looking at the pace of moves in 2025 from the Fed, and to a large degree, all central banks will have to deal with this. Jerome Powell giving us some lovely new metaphors to mess around with. Amidst fog and a room full of furniture, you move pretty slowly. I mean, I don't know which one to go with or which one to go to, but it does sound like a message that lots of central banks will be dealing with because there is going to be a lot of fog at the beginning of next year.
Yeah, a lot of fog. And this phrase that he used yesterday about entering a new phase of the cycle, his caution around rate cuts coming to the table is going to get the market to be thinking that we could have a Fed on pause for a substantial amount of time in 2025. And that poses risks, you know, not just to the U.S., but to wider emerging economies. You know, think about Brazil, who's already struggling with their fiscal headroom. If we have a Treasury yield still elevated all of next year, you know, Brazilian government bonds trade at a spread to Treasury. So the fiscal headroom for Brazil erodes even more. You know, perhaps the theme of next year could be EM sovereign defaults.
That would certainly cause some volatility, and in the past has caused the Fed to react. We remember various crises that we've seen in EM feeding through back into the Fed. Dan, is the Bank of England firmly sort of fog-bound at the moment? Should we be hearing warnings blaring across the across the square?
There's always fog, isn't there? And they're paid to look through the fog and work out what's going to happen.
Can you, at this point? How much uncertainty is there? The economy, all I'm hearing is stagflation at the moment, which is a really difficult kind of thing to navigate.
Yeah, and I mean, on the stagflation point, I think the bank, as an inflation-targeting central bank, it's inflation they're going to worry about. Growth's just going to be sort of the sideshow. I think there's going to be fog next year with Trump and the like, and the outlook for the UK economy itself. There are some issues around the tax rises that we've got and the like. But I don't think that stops them from giving us a little bit of a sense of where they're going, being a little bit more forward-looking.
Dan, Val, thanks very much indeed, both of you. Bank of England coming up a little bit later on. We've got some great coverage coming up. We're also going to be speaking to Anthony Blinken. A lot still to come on Bloomberg Television. This is Bloomberg.